Morning, everyone. My name is Ryu, and I'm here to take you to Consolidation statement together with an associate all in one question. Okay, so let's look at question five. Let's briefly go into it. Okay, so question five. Victory Limited has investments in two companies, Happy Limited and Comfort Limited. The separate financial statement of the three entities for 2014 are as follows. So these are what the entities what details of financial position in statement of profit and loss. So let's quickly move to the additional information. It said Victory acquired 6,250 shares of Comfort Limited in 2005 and a total cost and in 2005 at a total cost of 12,000. This acquisition gives Victory Limited significant influence over Comfort. At the date of acquisition, Comfort Limited retained earnings at a balance of 4,300 cedis. The fair values of Comfort Limited's assets and liabilities approximated their carrying amount. On page during 2014, Victory Limited acquired 32,000 of Happy Limited share at a total cost of 29,000. At the date of acquisition, Happy Limited retains earnings at a balance of 3,500. The fair values of the assets and liabilities approximated their carrying amount, except a piece of land with a carrying amount of 2,000, which are the fair value of 2,500. Here you can see there is an excess fair value adjustment. So we need to put it up in our working student. The fair valuation adjustment has not yet been reflected in a separate financial statement of Happy Limited. The investment income of Victory relates to dividend received from the investee entities as follows: Happy 800, Comfort 200, and Victory also paid an interim dividend of 10,000. Okay, note 4. In 2024, 2014, Happy Limited sold goods to Victory Limited at a markup of 20%. The goods cost Happy Limited 1,000 and one half remain in inventory at the year end. Instead, Victory undertakes annual impairment reviews of goodwill. An impairment loss of 1,500 has to be identified in respect of Happy Limited for the year ended 31st December 2014. So far, no impairment loss relating to Comfort Limited is identified. The group has the group has a policy of measuring non-controlling interest as proportionate share of net assets of subsidiary. Required: prepare a consolidated statement of profit and loss and other comprehensive income for Victory Limited Group, and the other one we all know as what consolidated statement of financial position. As at So to begin with, we first need, even though at first we need to what um, prepare what A requires us to prepare our profit and loss, we need to first have our group structure. Okay, so who's I think the company's name is Victory Limited. So, so Victory Limited. Okay. So the group structure, our workings, workings one, we have what? The group structure. Okay. So okay. So we have one, the group structure. So who is acquiring who? Let's see here. We said Victory acquired. So this is a subsidiary. This is a subsidiary. So let's say this comforts. Comforts. This is what happy. Their share capital they have is what? This is their share capital for both of them. Share capital is what? For comfort is what? This comfort share capital. This comfort. So this comfort share capital. 25,000. 25,000 at what? 0.5 or 1 CB rather. At 1 CB. That's the share price. And Apple's one is what? 20,000 at 0.5. So to find the number of shares, so percentage in what? Comfort was what? They said it acquired 2,650. So 2,650 divided by, then open brackets, what's comfort share? 25,000. And you remember, you have to divide that one too by the what? The share price. So this is, so this is the share. We copy it, we come here, we put, okay, it's not copying. So since it's not copying, let's just write it again. 2650 divided by brackets open 25,000 divided by 1 brackets close. Sorry, it is 6250 rather. 6250. So 25% here. And here we have what? 25% in comfort. Then He also had what 32,000. It acquired 32,000 shares in Happy. So 32,000. So here 32,000 divided by 20,000. That is in bracket always. 20,000 divided by 0.5. So let's copy this one and bring equal to, then paste. That's 80%. That's 80%. So NCI share, NCI percent. Here is what? 1 minus 0.8. So NCI share, here is dash, and here other investors also have a share here of what? 75%. That's it. That's it for our group structure. Guys, I'll do the workings first, then I do this one separately on another lesson to make it short for you guys. Okay, so workings 2, let's say 2, 2 is what? 2 is the fair value of net asset of what? Who is the subsidiary? Happy. Always use the name. I know it's a subsidiary, but always use the name of the subsidiary of Happy Acquisition. So that one is okay when you use this one. So first, we have at acquisition here. So at acquisition, we have acquisition here. At reporting, and we have what? Post acquisition. Post acquisition. Sometimes they say what? Post ac. So this is. So at first, what do we have? We are doing it for Happy. Remember, Happy is this second column. So we'll look at their equity share, their retained earnings, and if there is any adjustment, we put in there. So looking at it, this is the share for Happy. That's what 20,000. That's for reporting. So stated capital, that's what 20,000. Then the post act, yes, still the reporting minus the acquisition one. Yes. Then here we come to the retained earnings. Some question, the retained earnings wouldn't be given to you. But with this question, you could see they gave us a retained earnings in the question. You see, the retained earnings at reporting was given to us as 45,000, 4,500. and the retained earnings acquired in capital. I'm sure they gave it to us on fair unit 2024, every 3 years, 132,000 at a cost of. Here's it. The retained earnings that's been given to us, that's 3,500. So the 3,500 cancelled, giving us 1,000. Then we have to check for any fair value adjustment, if in. Okay. So let's see whether we have any fair value. Okay. Yes. The fair values of assets and liabilities approximated their carrying amount except with land. So you bring it, the moment you bring it down, with a carrying amount of what? 2,000 and a fair value of what? 2,500. So always use the fair value, this one, to compare the carrying value. When the fair value is greater than the carrying value, you have a surplus. That's excess. When the fair value is less than what the carrying amount, we have what? A deficit. So here we have excess of what? 500. 500. Is there any depreciation? Land, we don't depreciate land. Let's check if there is any other adjustment. I'm sorry for the inconvenience. I had some. Just a minute. Okay. So we check if there is any adjustment to be made. So okay, let's check. Are there any adjustments? Any unrealized profit or depreciation or any other. Let's see this. Note 4. Happy sold goes towards. So there is perhaps anytime someone sells good, always there is going to perhaps. So always check out for that when anyone makes any sales to a new person. So happy sold goes your victory at a markup of 20%. They said the goods cost what? Happy 1,000. Half of it remain in the inventory. So this is how you calculate it. You have the parts here. So then it will be out that's 0.5 multiplied by the cost multiplied by the rate. Since it is only the cost that's given to us, we don't need to change to markup or margin. It's already a cost. So we just need to multiply by the rate given to us, 20%. Hope you guys get it. So that one only affect the reporting period. So 0.5 multiplied by 1,000 multiplied by what will be 0.2, that's 100. Are there any more? No, that's all. So we are done with this one. Let me highlight the ones we are done with, so we don't need to go back to them anymore. So I like this one. We are done with. Okay, we're not done with this one. But I think we are done with this one. Right? We are done with this part. This part exactly we are done. Okay. So we left with part of what's it called. So let's just so this one is negative, sorry. Always part must be in brackets. Not just. So this one is negative. So let's check again. Are we done? Please, are we done? Okay, so if no one is talking, let's just add it up and move on. So we add the following. So sum this one up and bring this one here. So there is a post arc of what? 900. So that's that for our working skill. Okay, so that's our working skill. Please, after I'm done with the workings, I'll just have to stop it to make it short and not times. Okay, I just want to make it short for you to just. So now we move to the working story. Okay, that's the words goodwill at acquisition. Okay, what goes into what is goodwill? Goodwill is simply the word, the excess of purchase consideration over its net assets. That's goodwill. So what's the purchase consideration in the question? The purchase consideration. Let's see whether we have different type of consider. We have cash, we have shares, and we have deferred contingent. There are about five or so. So always take note. They can give you two in a question, or three of them can see. Let's see here. Okay, so they give us at a post. So this one is a cash consideration. So the cash consideration of what 29,000. Then what again? Remember, they told us to value this non at a what proportionate. So proportionate. Take note. So these are purchase consideration cash. Then just a simple, we don't have to do also. Then we less. What do we have to less? less fair value of net assets at what? Acquisition. With that one, we don't have to less everything. We only take a portion since we are doing it as a proportion. We only take the portion that belongs to what? That belongs to the parents. So we only take this one. What do we have? 24,000 times the parent share 80%. So that's what we do here. So since it has to be in bracket, let me bring a negative here. 24,000 times 80%. Was it 80%, right? I think 80%. Yeah, 80%. So yeah, we just add both of them. Or you can take this one, or simply put, let me not confuse you. So we only need to take this one, always take note of this one. Less. So this one we have to less it. So lessing it will be equal to what? This one minus this. It will give us this. Hope you guys are okay. So these are goodwill at acquisition. Did any impairment occur or something? Mm, An impairment loss. Yeah, there is an impairment of what? So we also less impairment. Yeah, we less full impairment, which is 1,005. That one also you less it. So let me put in this one here. You have to less this one too. So this one minus this to give us what? 8,300. That's that. You're done with workings what? Workings 3. So let's go to workings 4. Workings 4 is our what? It's our non-controlling interest. NCI. Please write it in full. Okay. So yeah, we just need to, since NCI as proportionate. Let's say we always write NCI at what? With what? So here's the way you put. All you need to do is what? Take this reporting figure, 2,000, 24,900, then you multiply by the percentage, this one almost. So what is the NCI value we have? So weightage equals 24,900 times this portion. before 980. So we are done. But remember, it told us what an impairment loss of 1,500 has been identified in respect to what happy limited. So we have to take. No, I've forgotten. Since goodwill is being valued as proportion, parents will bear all the impairments. Okay, so let's move to working five. We're almost done with the five workings. Then I have to close the video and start all over with. We just need to do the profit and loss and this one. So I beg you, please just keep the figures somewhere. Okay, so we have our workings five to be what group retaining earnings or the group income surplus. Group retaining earnings or group income surplus. So the balancing figure, we take it from the balance sheet or the financial position. There's it 417830. So 417830. Then add share of profit in post act. You remember we had post act share was what? So that share will be what? You know, the share is 80%. And we had a post act to be 900. So here will be David, then add share of profit in what associate. You know, associates have what? They own 25%, right? Based on what we calculated. So 25% of what the awards within earnings at reporting members. Their retained earnings at start, which was given to us as 4,300. Remember, with the share of profit in associates, when you are calculating the share of profit in associates, if the retained earnings hasn't been given to you in the word footnote, as we see at the 4,300, remember, and you've been given stated, what is it called, profit and loss. You just go to the profit and loss. You just go to the profit and loss and pick the profit for the year for the word associate. And if there's a proration, that's 6 months or something, multiply it by the profit of the associate, profit for the year for the associate, times the prorated month. Then you multiply the same thing, amount that you add by the what portion of the what, associate, portion in associate. That's the 25%. Remember that, please. Okay. So it was Then we have 0.25 multiplied by 9,900 minus 4,300. You have 1,004. Is there any impairment? Yes, there is impairment. We have impairment of what? Impairment of what? 1,005. Remember, I told you the full 1,005 will go to the what? The parent. Okay. So do we have anything now? No, I don't think there is anything now. But this is the impairment in what? SAPs. If there is impairment in associate, you take that one out here. And remember, the share of profit you brought in associate, we will have to go to the what cost of investment. So you, when we are doing the cost of investment, just focus and you see. So we have to, based on mine, I'm using this one, so I have to add everything now. Then there's it. Working 5 down. So after the last working, I'll alt for you to go through, then I continue again. So working 6, cost of investment. That one is the same thing. Almost, it's almost like what's it called? Um, the goodwill. It's almost like that. Yes, this one is for the associates. So the purchase consideration. Do we have a purchase consideration for this? Yes, we have. Yeah. It said Dutry acquired what 6,250 in comfort in 2005 at the total cost. This is the cash. So this is the cash consideration of what 12,000. Then you add share of profit in associates. I'll bring it here working 5. We already did it this, so I'm referring to that side. This figure, 1,400. Is there any impairment? No. So what do we do? All we have to do is what? Add them. So let's add them to get our what? Cost of investment and associates. I'm sorry. So there's it. We are done with the workings. So guys, thank you for staying with me for this working. Hope I'll see you in the continuation dealing with the profit and loss of it. What's it called? The financial position. Thank you very much for staying. Bye bye for now.